Hey, what's up, everybody? It's TJ with Strategic Real Estate Experts again, and today we're talking about super fun stuff, credit. And more importantly, how does your credit affect your ability to get a mortgage? So what you really have to understand is your credit score. Lots of people have probably heard about it, tons of misconceptions around it, what's good, what's bad, what's not. So first, you need to know if you have a score and what it is. There is a website called annualcreditreport.com. You can go there and get a copy of your credit report. This is important to do, especially for those of you that listened to our last video and understand we should start a year out so we can boost your credit when the time is right to buy a home, because the higher we can get your credit, the better the score we can get you. So what you need to understand is lenders will lend money to you when you don't need it. So if you have a lot of money in the bank and great credit, they'll give you the money, like no problem. However, if you don't have lots of money in the bank and your score isn't high enough, it's going to be tougher for you to get a loan. And if you do get it and your scores aren't high, you're going to pay more in interest. So what you have to understand is they use a scoring system called the FICO score. The points can range anywhere from 300 to 850, with 300 being the worst and 850 being the highest. So obviously if you're ranking up in the 800s, honestly over 760, 790, you're good and probably not going to have an issue getting a loan or qualifying for a loan if that's something you're trying to do. The thing with it is they track information. So the FICO scoring system is going to track your personal information, who you are, where you live. They're going to look at your credit inquiries. So have you been pulling out lots of credit card inquiries, trying to get a loan on a car, anything like that? Do you have other mortgages? They're going to look at the credit accounts you do have. So again, the credit cards you do have open, a car loan that you have, if you do have a mortgage, if you have student loans, all of that stuff. Plus they're going to look at if there's any collection items out on you. So if you owe medical bills, anything like that, that is against you. And finally, they're going to look in the public records to see if you've had a short sale, foreclosure, a bankruptcy, a divorce recently. They're going to look to see this global picture of where you're at. And then they weigh all of those items. And we don't know the actual algorithm they use, but we know that they look at your payment history. So have you made on-time payments? We know that they're going to look at how much you owe relative to the amount of credit you have out. So if you have $100,000 in credit cards and you owe $100,000 in credit cards, that's not good. But if you have $100,000 in credit cards in theory that you could put out and you only owe $1,000 or nothing, that looks good. The other thing they're looking at is the length of your credit history. So what I'm talking about here is how long have you had a trade line, they call them. So a credit card open, how long have you been paying on some type of mortgage that it could be, or a car loan. The longer those are, the better. So if you have any accounts, don't shut them down. The other thing they're going to look at is any new credit that you have and what it's for. And they take all of these things into their algorithm and then they go, here's your credit score. The higher we can get that, like I said, the better. So especially for first-time buyers, if you're in the 600s, we can probably get you up fairly quick to get you a loan. But we know the higher we can get that score, especially if you start a year out, we're going to be able to get you a better loan, better rate, which means you can qualify for a better house at the same payment amount. Because I know if one person can get 5%, but yours is 5.5% because your credit isn't as good, that reduces your purchasing power by 5%. So let's say the person that's at 5% can buy a $200,000 house. For you to buy a house and have the same payment, you have to spend $10,000 less. So you would be able to buy a $190,000 house. So look, there's things you can do to help make sure your credit score is going up. This is just quick, easy stuff. Make sure you stay under 30% of any of your credit cards, the amounts. So if you have a $1,000 credit card, don't go over $300 and then pay it off every month. The other thing you can do is make sure you're keeping your accounts open that are older. Just because you're not using them, don't close them down, because long trade line histories, long credit card histories will help your score rank higher because it looks like you've been able to establish credit for a long time. Okay? So the other thing you want to do, make sure you keep paying all of your stuff on time. Don't have any late payments, and don't go into default on anything. So if you want to know more about like specific scores, stuff like that, we're going to have more videos and stuff that come out. But if you want to start getting a game plan together, you can reach out to us. Visit us at knowbeforeyoubuy.realestate.com. You can text and call me, 608-576-0044. Email tj@sreehelp.com. And as always, raise your standard, and we'll talk to you soon.